Hello again, and welcome to Credit Versio's Q&A Wednesday live for July 28th. I am your host, David Michalek. I am a credit expert with nearly 9 years of experience, and during that time, I've conducted over 10,000 one-on-one credit consultations, and I'm looking forward to helping you understand and improve your credit on our live weekly Q&A calls that we do Wednesday on both our Facebook and YouTube channels. So please take a second, introduce yourself, and let me know where you're from. And if this is your first time joining us today, thank you so much for being here. We're going to make this an awesome experience for you, and you're going to come away with a lot of great knowledge on credit. And every week you're going to hear me say this. Our credit report plays an enormous role in our lives. Our insurance companies, landlord, mortgage broker, utility providers, our bank, and even our employers are looking at our credit report to see how we honor our obligations. Today, credit reports have become more than just a credit report. They are our adult report cards, and they tell the story of how we honor our obligations. That's why we do these weekly live Q&A sessions, and that's why today I've got with me America's #1 credit expert, formerly with FICO, formerly with Equifax. Let's welcome John Ulzhiemer. And I'm going to play a quick intro video, and then we're going to get started.
John Ulzhiemer is America's most recognized credit expert with 30 years of experience in the credit industry, having worked for both FICO and Equifax. He's the go-to authority for answers to credit questions. Here to answer your credit questions, Credit Versio presents John Ulzhiemer.
John, welcome. Another great opportunity to educate a bunch of people today on the subject of credit. We had a crazy call last time you were on. We went almost an hour and didn't get to about half of the things that I wanted to talk about because we had so many questions that people asked. If you remember when we talked last time, 2 weeks ago, one of the things that I wanted to talk about was this huge decision that Wells Fargo made recently. It made news about 2 weeks ago. It's all over the place. It's still a hot topic, which is they canceled home equity lines of credit. But that didn't make a big splash, probably because there's just not as many people with home equity or homes as there are people with personal lines of credit, which they canceled. Gave everybody a heads up, and all of those lines of credit that millions of people have from Wells Fargo are now gone from there, or not going to be active anymore on the credit report. So we're kind of starting out of the gate with that question because I want to make sure we got to it. And I wanted to get your take on, and one of the things they did talk about is, hey, this is likely going to impact people's credit scores. And that's the thing that a lot of people are excited about is, here are these lines of credit that people have. They're going to be shut off. And what is that going to do to people's credit score? And maybe we can start with that.
Sure. And by the way, thank you for having me again. I always enjoy the fastest 45 minutes on the internet when we have our we do our thing every few weeks. So yeah, that's right. So Wells Fargo shutting down their what's referred to as an unsecured personal line of credit. And so back in the day, those were called signature loans. Meaning that what secured the loan was your signature, which is kind of the euphemism for saying that your credit is securing the loan.
Yeah.
And these are revolving accounts, meaning that you can take money out and you get a bill and you can pay it back, and then kind of replenishes the limit, just like a credit card is structured. And so by closing, it doesn't really matter who closed it or why it's being closed. The backstory is not relevant to credit reporting or credit scoring. What is relevant is that it's going to be closed. Yeah. And so the question is well, okay, well, now what? Well, first off, you're losing the capacity to use that particular unsecured line of credit. So what do? You go out and get another one if you want it, right? I mean, there's like 10,000 lenders in this country. And so if you want another unsecured personal loan, trust me, there's another lender just down the street that would love to chat with you. So the myth that is being kind of spread in the blogosphere from the kind of the self-styled credit experts is that by closing this account, that this is going to lower your credit score because you're going to lose the value of the unused credit limit. And so this myth also is pretty common in the world of credit card blogging, where people say, don't close your credit card because it can lower your credit score. So where there's disconnect between the two is if you close a credit card, your credit score can go down because you've lost the value of the unused line, and your utilization ratio may go up as a result because presumably you still have some balance, but now you have less credit limit than you did beforehand, and so the ratio is going to go up and your credit score can go down. But that ratio only considers credit cards. It doesn't consider home equity lines of credit, and it also doesn't consider these unsecured personal lines of credit. And so even if one of these accounts is closed, and the same thing with a HELOC, if someone closes your HELOC, if you close your HELOC, even though you're going to lose access to that particular credit limit, the credit scoring systems were not rewarding you for it in the first place, because credit scores only consider credit cards when they're determining that balance to limit ratio in utilization. So
that's a big deal. And like you said, myth, that's something that a lot of people have wrong right now.
That's right. I get it. And it's fun to talk about, and it's fun to yell about on the internet and make YouTube videos about it, but it's not true. HELOCs and personal lines of credit, while they may be revolving type accounts, are not considered in the credit card utilization ratio, which is the common ratio that we constantly talk about in FICO's credit scores and VantageScore's credit scores, because those ratios are designed to only consider credit cards. Now, the follow-up question that I normally get from someone who wants to argue with me is well, how in the world can FICO tell the difference between a credit card and a HELOC, or a credit card and an unsecured personal loan? They kind of look the same on a credit report. So how in the world can FICO tell the difference? Blah. So let me answer the question. So in the credit reporting language, which is called Metro 2, there's actually coding that is associated. It's called an account type code. And there's actually a code that's associated with a credit card, with an auto loan, with a mortgage, with a HELOC, with a personal loan, a student loan. There are codes that actually clearly identify the type of account that is being reported. And obviously credit card issuers can only report credit cards. They can't report mortgages. They can't report personal loans. They can't report auto loans. Auto lenders can't report credit cards, and they can't report mortgages. So it's not a mystery when something is showing up on your credit report what type of an account it is. And sometimes you'll see it actually show up on a credit report like a disclosure, like what we have access to as consumers, where it clearly indicates, Wells Fargo credit card, Wells Fargo HELOC, Wells Fargo home mortgage, Wells Fargo auto loan. So that's being driven from the account type coding. And so FICO's credit scores, this is software, so it's all a programming issue. Mm-hmm. So the credit scoring systems are programmed to look for the account type so that it's treated very specifically in credit scoring systems. So there is no accidental consideration of HELOCs and these unsecured revolving personal lines of credit. It's not accidentally interpreted as a credit card because it is clearly identified as a personal line of credit or a HELOC or a credit card in Metro 2's credit reporting language. And so that's how scoring systems can tell the difference between these different types of accounts. And you can drag this out all the way to utilities, collections, auto loans, student loans, boat loans. There's an endless number of account type codes for pretty much everything you can possibly think of that'll hit your credit report. So there is no mystery of what type of an account it is when it hits your credit report.
This reminds me of one of the first credit summits I attended with you. And for those of you watching, the credit summit is where a lot of people like myself go to learn from experts like John. And one of the early things I remember you talking about was the difference between a credit disclosure and a credit report. When you said, "Hey, listen, nobody has ever seen a credit report. Everything that we see that we call a credit report is in fact a disclosure." And I don't know the exact measurements you were using at the time, but to maybe just paraphrase it for lack of a better word, you said that, our credit disclosures are maybe like that if we were to measure them in size, and our credit reports are probably, wider than I can reach my hand as far as the data that's actually on them. So we're just seeing a snippet, but a lot of it in the background is just a lot of data and code that isn't really too relevant to the average consumer.
Yeah, if you saw a legit, but everyone just calls them credit reports because no one likes to say things like, "Yo, I saw my credit disclosure last week." No one says that. Right. I mean, they say I saw my credit report last week. So if you were to see an authentic credit report, you wouldn't know what you're looking at because it's all comma delimited code. Mm-hmm. If you understand Metro 2, which is the language, then you may be able to pick out some of the fields because you may recognize some of the characters, the alphanumeric and alphanumeric characters that make up Metro 2. But if you're a layperson and I threw a credit report up on the screen, you would have no idea what you're looking at because it's just a bunch of numbers and letters and commas, and that's it. Which is why consumers don't have access to those because they have no idea what all that stuff means. But it's machine readable. So application processing systems can see and understand those credit reports because they're designed to be fed into Fannie Mae and Freddie Mac's desktop underwriter and loan prospector. They're designed to be fed into the various automated application processing systems. They're not designed for us. And remember, there was a time when the credit report wasn't even available to consumers. It was only available to the users of the credit reports. And so accordingly, the design of the credit report was never intended to be for me and you. It was designed for the banks and for the credit unions and for the credit card issuers. It was only when the Fair Credit Reporting Act was amended to require that consumers be given the ability to see their reports. And by the way, the Fair Credit Reporting Act calls it disclosure of your credit report, which is why it's called a credit report disclosure. And then, of course, those were designed for consumer consumption with the information in plain English, very readable with legends and color coding and explanations. And so that's why you have this very different type of deliverable. And the only time that I really make this delineation, other than when we're on this, our weekly Zooms or videos, is in expert witness work, because there is a huge difference in litigation between a disclosure and an actual credit report, especially when you start talking about allegations of credit damage. And, look at this thing on my credit report, and a lender can see this, and it's really a disclosure, and really no lender has access to it. So that's the only time where it kind of rears its ugly head, is when you start getting into the world of consumer credit litigation.
Let's get to a couple of questions. We got a few piled up here. The first,
and I'm going to shut my door while you're doing that to kind of keep it quiet in here.
Okay, sounds good. We'll do a quick pause.
Go for it, David.
Illmatic, how does the credit bureau say, let me put it back up there again, expired. How does the credit bureau say they have verified your BK and you opted out and froze all three-party credit bureaus access, such as LexisNexis, SageStream, and several others? And he says, I'm from Illinois. That's a good one.
Birmingham, Alabama.
Oh, what did I say? Illinois? Yeah, Alabama. There you go.
Illinois, Alabama. What's the difference?
Yeah.
Yeah, so I mean, this is kind of a credit repair question, but I can tell you that security freezes that's not the function of a security freeze. And so I'm not sure who sold you that a security freeze prevents these other parties from verifying information, but it doesn't. A security freeze prevents lenders from access to your credit reports, users. So it doesn't prevent Equifax, Experian, and TransUnion, who all use LexisNexis as a public record vendor, not as a credit bureau. So the security freeze, while it's great that you have those reports frozen, it just prevents the legitimate users of that data from accessing it without your opinion. It doesn't prevent one party from using the service offered by LexisNexis, which is as a public record vendor.
Yeah, this is a myth that just will not die.
I know. It's in credit repair books. It's in credit repair blogs. It's on, people screaming on YouTube videos about how you should do this. So anyway.
Yeah, and it's always these very anecdotal situations that come up where they get something deleted, and they automatically attribute it to that. Well, that has nothing to do with how things actually get deleted. So this, I wish one day this LexisNexis save string freezing thing would just disappear, because it's not something that works. Okay. Same person question. How is it possible for a collection agency to send you a bill from the supposed original creditor and supposed balance is incorrect? What are my options to handle this?
Yeah, again, this sounds like Illmatic is trying to get stuff off his credit reports. So, I mean, I can explain. I don't know who the collection. I can't speak from a first-person perspective, so I'm a little handcuffed vis-a-vis your question. But debt collectors, when they get a debt consigned to them from an original creditor, the original creditor represents what the balance is. And if the debt collector is also a debt buyer and they buy the debt, then they can start charging interest, which means the balance is going to change over time. If they have a judgment, then judgments can also accrue post-judgment interest. And depending on the state that the judgment is filed in, it's going to control the amount of interest that can be charged. And so the balance of a collection doesn't necessarily have to be the exact same balance of the amount of the default with the original creditor. There are fees and interest that can accrue when a collection agency gets their hands on it.
Excellent. Rick's back with more of a comment than a question. Experian kept reporting my Toyota financial car payment as a credit card. I'm assuming that meant like revolving account. I disputed that. They finally corrected it. Those CRAs get a little crazy sometimes. Not really a CRA thing.
Yeah, I would think that that's a Toyota thing more than it is an Experian thing.
Yeah.
But it's interesting. I don't think Toyota issues credit cards. Toyota Motor Credit, I think, just finances automobiles. So yeah. But like I said, the account type code and for Toyota, there's also a subscriber code control for that. So that's an interesting issue and how that happened. But to the extent they corrected it, that's fantastic. The subscriber code that is assigned to someone like a Toyota Motor or a Honda Finance or a Mercedes Fund, any at Ford Motor Credit, any of the captive auto lenders that only do one thing, they only finance cars. The subscriber code that is assigned to them by the three credit bureaus is specific to auto lending. So I'm actually kind of surprised that happened in the first place. But that's why we have an FCRA, because it gives you the right to challenge that stuff, Rick. And I'm glad they got it corrected. I will tell you this: it helped that they corrected it, because it's always better to have an installment loan and installment debt than it is to have revolving debt. So one type of debt is treated very differently in credit scoring systems than the other. So kudos to you for staying on it and getting them to finally correct it.
Yeah, that's a big thing, Rick, and everybody who's watching is, credit is not something that you really want to take your eye off of. I've had an active Experian app on my phone for probably about 9 years now. And yeah, I pay monthly for it. I think it's $25 or something, but it's $25 well spent. It doesn't matter. It's Experian or Smart Credit or whoever you got, or you don't pay for any of them. You just go to annualcreditreport.com, and I think every 2 weeks now, John, until 2022,
every week. Yeah,
every week
from all three bureaus. If you really want to get your credit reports that often, you can pull all three of them from Annual Credit Report through at least April of next year. I kind of suspect that that's going to get extended again, because why not?
Well, it might just become the norm now.
That's right. It might just become the norm.
Yeah. Scott Oliver's back. Hey, Scott, good to see you again. If there's a collection on the report and that company is still asking to get paid, should a person pay it if it's scheduled to fall off the report soon? That's a question, John, you and I both like, but I'll have you take your first stab at it.
So there's a couple things. So just because it's not on your credit report any longer doesn't mean that they can't still try to collect it. So that's number one. But regardless of what you do, whether you pay it or ignore it, it's got to come off after 7 years. There's nothing you can do that extends that 7-year period. period. That's called reaging. If they change the anchor date to something more contemporary and then cause it to remain longer. So, but that's a decision you get to make, Scott, as to what you want to do. But you may still get phone calls from them. You may still get letters from them, and depending on what state you live in, they can still sue you. So depending on the statute of limitations for time when it becomes a time bar debt. And if it's a small dollar collection, probably not. If it's thousands and thousands and thousands of dollars, they probably would have already sued you by now, but it's always still a possibility. So again, that's a decision that you have to make, but I just want to be clear that just because it's not on your credit report any longer, they don't ever have to stop attempting to collect it. There is no statute of limitations that prevents them from collecting it for the next 50 years. They can certainly do so, but they can't credit report it, and eventually they're not going to be able to sue you unless you do something silly like make a payment or promise to make a payment after the statute of limitations has expired.
Yeah, John, one thing that I've seen frequently, and Scott, this isn't meant to scare you at all because this is the exception, not the rule. But dollar amount sometimes doesn't seem to matter. I've seen some big collection companies that if I mentioned their name, John, you would certainly know them, that have sued over $200 or $300, and sometimes they do it right before that the end of that time bar date, whatever that is. So you never know. I mean, you never know what they're going to do. So it's always good.
Man, if it's a small dollar amount, I mean, they know 7 years is the limit. That's not a secret to their debt collectors.
Yeah.
If it's a small dollar amount, maybe offer them a really small settlement amount. And then if they take your settlement offer, then you not only can it not be credit reported any longer, but you paid de minimis, and that's it. They can't sue you, and they can't keep collecting the debt because it's done. And so you've really solved almost every problem that you possibly could have because and paid a small fraction of what you actually owe.
Yeah. And also too, I think I guess the important answer to questions like that is, if you got a debt that's outstanding, and it's always the best thing is always to try to honor the debts that you agreed to pay. Of course, it's a personal decision for everybody, but I don't think anybody on here is going to ever be an advocate of not paying something that you owe. Okay, sure. Rick got a question, more of a lender qualifying question on the credit card side. So big question: can a credit card company deny you for a card account because you are I guess on Social Security disabled person? I have good credit and got denied because of being on Social Security and not employed.
So that's an ECOA question. So every time you walk into a bank, you see a little plaque that indicates that we don't discriminate based on this, and this. And there's a whole long list of things that they have to disclose that they don't discriminate based on those things. And so obviously you can't deny somebody because they're disabled. I mean, that's I can't even imagine a bank doing something like that.
It's a big open door to a lawsuit right there.
Yeah, if you got a letter from them saying we denied you because you're disabled, I can point you to a number of attorneys that you probably should talk to after we get off this webinar. But certainly you can be denied because of income or a lack of income. In fact, the CARD Act, an Obama statute, requires them to deny you if you don't have capacity to make payments. And so that is certainly a reason why you can be denied, but certainly not because you're disabled. But if you were denied, what you did get, Rick, is you got a notice of adverse action, which most of us just call denial letters. And so the denial letter is going to indicate why they made that decision and what data they relied upon to make the decision. So it really shouldn't be a mystery as to what they're telling you is the reason for the denial. But I'd be really surprised if the adverse action letter indicated that they denied you because you're disabled. That would be a pretty whopping ECOA violation. if you're talking about Social Security and not having a job, then it's probably more of an employment-based decision, which not only can they do, but they're actually required to do.
Okay, looks like a question for me. I'm Mustafa. David, I have a question. Can I dispute on Credit Versio and take actions on smart? It's actually smart credit at the same time. I don't recommend it. You're going to send maybe conflicting messages. Just stick with paper disputes. You really don't want to be in smart credit doing anything until maybe after you're done with your dispute process. Rick, it's FNBO. I'm not sure I know. Do you know what that means, John?
First National Bank of Omaha.
Oh, okay. Gotcha. Okay. All right. Shoot your questions up if you have one. And so, John, this was a subject that you wanted to talk about that I thought was a fantastic idea. One of the subjects that I get questions on quite a bit, but until we talked about it or emailed about it earlier today, I didn't think to ask about it. So we're going to talk about. Well, in fact, John, why don't I just let you introduce it since it was your idea and I thought it was an awesome one.
Okay. So here's the most complicated slide I've never made.
All right, here we go. So I'm going to bring up a slide, and we're gonna look at a trade line. So this is a trade line on a 3-bureau credit report, and John's going to walk us through it, and we'll go back and forth between the two of us.
God, what a mess.
Okay, so this is not going to be as intimidating as it looks. Let me slide this down a little bit because it looks like it's not coming across for everybody. Okay, yeah. There we go. All right, so we're going to do a little bit of this. We're going to go back and forth. John, if you want to pick one or two of them, and then we'll come back. You can talk us through it.
So first off, let me set this up and explain why you're looking at this. So the reason we're looking at this is David and I had a conversation earlier. I got a really good question about what is the most valuable component of a trade line. And I for a minute, I thought, that's a really good question. I'm not sure I've been asked that question before. And, I'm going to answer it from a credit scoring perspective because that's my background. And so what we're going to do is we're going to walk through this fictitious Capital One trade line on a 3-bureau report. And what David did, thankfully, because I don't have the PowerPoint skills that he does, is that he actually kind of put a little circle with a number in it and then pointed to the different field on the credit report. See how? So number 1 is the name of the company. Number 2 is the account number. Number 3 is the high balance. So we're going to go through, I think there's 18 or 19 of those, David. And so we're going to go through those, or 23. And so I'm going to identify a couple things. First off, I'm going to identify, remember we talked about earlier about the difference between a real credit report and a disclosure and how the information isn't the same. I'm going to identify, of all those 23 fields, what is actually on an authentic Metro 2 credit report versus what's not. And then we're going to talk about the 5 prongs of credit scoring: the payment history, debt, time and file, inquiries, and account diversity. And I'm going to talk about which of these different 23 attributes, if any of them, are considered by credit scoring systems, and which of the 5 prongs by which they are considered. And so that's going to help to answer the question, well, what's the most valuable part of a trade line? Where the answer really is, it depends on the consumer and it depends on the trade line. So it isn't, I think the knee-jerk reaction is as well that the fact that it's paid on time is the most valuable part of the trade line. That may not necessarily be true. And so really the value of the trade line to your credit score isn't going to be the same as the value of a trade line to my credit score, or David's credit score, or anybody else's credit score. So I'm just going to kind of take it from a global perspective and go through all of it, and then kind of identify what's considered and how and where it's considered.
And the most magnificent thing is John's going to pull this off in about 20 minutes.
That's right.
All right, and also John, if you want this, I got this as a visual too. There we go. I don't know if that helps you.
I'm going to be referring to it, but I don't think you don't need to flip back and forth to it if you don't. I think people know that there's a 35, 30, 15, 10, 10 pie chart, FICO pie chart floating around out there on the web.
There you go. All right. I thought if you want to make reference to it, I got it. All right. Let's get
John Ulzhiemer.
Oh, hello.
We're going
That's
back.
Me. I'm back.
Hold on. Let me see where that was. No. There we go. I lost it for a
All
second.
right. So number one, Capital One. So clearly that's the name of the lender, or in credit vernacular, that's the furnisher. They're the furnisher of the information. Obviously, the name of the creditor is not relevant to credit scores. Doesn't matter who you have your accounts with. You're not penalized for doing business with Cap One versus Wells versus any other lender. What is relevant in under number one, which you do not see, is the subscriber code that has been assigned to that particular Capital One trade line. This appears to be a credit card, and so this particular subscriber code would indicate that this is a national credit card issuer. So that's important because now credit scoring systems know that this is being furnished by a national credit card issuer, which obviously differentiates them from being an auto lender or a debt collector. Number two is the account number. Account number is completely irrelevant in credit scoring systems, and so it doesn't matter if it's a long account number, a short account number, what the numeric characters, that's entirely irrelevant. Number three is the high balance, and so this is actually a real field in credit reporting. It's the generally referred to as the historical high balance, which is the highest balance that you have ever had on the card that was reported to the credit bureau. And so that figure may actually be higher than whatever the credit limit is of the card at that point in time, especially if A, your credit limit has been lowered over time, and B, if you've ever gone over the limit on your credit card. And so the importance of the high balance figure only comes into play if the actual credit limit field is missing. So for metrics like the utilization metrics, so your balance to limit ratios, if the credit limit on a trade line is missing, then the credit scoring systems default to the historical high balance value and use that in lieu of your credit limit. So that the long and short of it is that it's only seen and considered by scoring systems if the credit limit is missing. But yes, it is in fact a real component to a credit report.
You see that often on, say, like an American Express, where some of those cards don't have a limit.
That's right. And credit and American Express, if it's a charge card, then the charge card's not considered in utilization. But if you do have an American Express card that has revolving terms, then it would be considered in utilization.
Excellent.
All right. Last verified, that is not a Metro 2 field, and so therefore that is not considered. Date of last activity, which is one of the, I always make fun of this. There is no such thing as date of last activity, but we're sitting here staring at it. In Metro 2, there is no date of last activity. It doesn't exist in the credit reporting language, so it is not influential to your credit scores.
A lot of people misinterpret that and they think, oh my gosh, that re-aged my account. We get that all the time.
That's right. And so, maybe one of these next videos we do, we really take a deep dive into reaging, because reaging first off, you can't reage a credit card. So usually when they're talking about reaging, we're talking about debt or third-party collection accounts. So to the extent, I guess theoretically you could reage a defaulted credit card, but we should dig into that. I mean, there's multiple organizations that have no love for the industry that have defined reaging, and it's pretty clear what it actually is and what it actually isn't. So we should dive into that one day.
Yeah. Also, too, for you watching, John wrote a great article about reaging that he just delivered to me. It's not up on our website, but if you go to creditversio.com, there's a credit coaching section. And John, I think you got probably maybe at least 10 articles and videos there now. So it's a lot of great information if you want to go through and look at the different subjects. Okay.
So the date reported is a date that the credit bureaus place on a trade line indicating the last time they received an update. That is not a date that is sent to them by the furnisher. So Cap One did not send any of those credit bureaus anything called date reported. But obviously, the credit bureaus all received information from Cap One on those dates, and that's what that is meant to represent. Date open, that's a no-brainer. It is absolutely a Metro 2 field. It is provided by the furnisher. It is, and if you want to throw up that pie chart, David, if that's something that you can easily.
Oh.
Yep, that's it. the date opened would fall neatly into that kind of lime green 15% length of credit history pie, slice of the pie. That's one of the dates that is used in the metrics in that 15% category, which people completely discount and never think about it when they're thinking of ways to improve their credit scores, but they sure love to talk about inquiries. The time and file metrics or the age-related metrics absolutely consider the opening date of your accounts. So it's important that that's correct, and obviously older is better. Your credit scores will reward you for having old accounts. Balance owed, there's no such thing in Metro 2 called balance owed, but to the extent that that really means current balance, which makes perfect sense because that looks like that would be the balance, the current balance as of the most recent date that it was updated. So current balance is absolutely a Metro 2 field, and it is meant to indicate the balance as of the most recent update. Or in credit reporting, it's called the date of account information, which would be the current date if you have an active credit card account that you're using and paying every single month. That balance is considered in the utilization metrics, and so it absolutely would, and other metrics, and so it absolutely would fall into that 30% category in the pie chart, which is the amounts owed category. So one of the myths about that 30% category, kind of that darker green, is that the only thing in that category is utilization, and therefore utilization is worth 30% of the points in your score. That's wrong. There are multiple other factors that fall into that piece of pie. Utilization is only one of them, but there are several others. Number of accounts with balances is one that is a big one. And so balance owed would absolutely fall into that category. The date that it was closed is...
Now we're on number 9, it looks like.
That's right. We're on number 9. So the date closed is not relevant. It's not a Metro 2 field. However, you do have to indicate that the account is closed if it is closed. And that's important because credit scoring systems treat accounts differently, whether they're open versus whether they're closed. There are certain metrics that are ignored if accounts are closed, and there are certain metrics that are not ignored. So that's an important field, even though it may not necessarily be called the date closed in Metro 2. So the next one is number 10, the account rating. So open. First off, there is no such thing as account rating in Metro 2. And what I thought that may have been referring to would not be accurate if it's indicating that the account is open. So, but then if you look, hold on, David, if you put that, if you go down to number 14, you'll see account status, open. Account status is a Metro 2 field. And so I'm going to really confuse everybody. Open has two meanings in credit reporting. So open can mean the opposite of closed, right? So if the account is open, you can currently use it because it's not closed. And then open also means that the payment is due in full every month. So you have open terms. So there's revolving accounts, installment accounts, and then open accounts. So things like your utilities are open accounts because you have to make the full payment every month. The American Express Green Card, the charge card, that's an open account. You have to pay it in full every month. Collections, you don't have revolving terms or installment terms on a collection. They're open. You have to pay in full once you get the demand for payment. So I don't know if that account status is supposed to indicate that Cap One card is a pay in full every month product or not, or if it's just another way of them saying the same thing they say below, which is that the account is open and not closed. But anyway, nonetheless, account rating is not a Metro 2 field. Account description, individual. There's actually a field in Metro 2 called the ECOA field, and the ECOA field identifies the relationship between the consumer and the account. And so you'll see things like the individual cardholder, joint, cosigner, authorized user. So that looks like that's actually mapped from the EC. If you want to throw that back up there, David. So if it looks like it's that account is being showed as an individual account, which to me, I believe account description is being mapped over from the ECOA field coming from the credit bureau. So dispute status, There's no such thing as dispute status in Metro 2. However, there are codes that indicate that the account is in dispute. Those are called compliance condition codes, or CCCs. And so the lack of any of those codes would indicate that the account is not actively disputed. So that, to me, seems like that's what that's doing, is it's looking at the lack of any of those codes and indicating to the consumer that the account is not currently in dispute. Creditor type, that's that account status that we talked about earlier, or the account type that we talked about earlier. This indicates that it's clearly a credit card. Account status, we already talked about that. Payment status.
We just finished 13, now we're on 14.
That's right. So payment status, believe it or not, this is actually called the payment rating in Metro 2. And this would indicate that the account is paid as agreed. So it would have a payment rating of 0, and the payment rating of 0 in Metro 2 indicates that the account is current. So that's obviously good. That means paid on time. Creditor remarks are what are referred to as narrative codes, and so you can actually throw a code onto a trade line that adds context to the account. So that one, if I remember correctly, if you want to put that back up there, David, indicates that the amount on the high credit column is the credit limit. So that would be a narrative code that can be added by the furnisher or the creditor. So the 1, 2, 3, the next 3 lines, and so that would be 17, 18, and 19. These are all trended data, or actually the next two. The next 2 would be trended data fields. And so this would be the historical payment information. Believe it or not, you have 24 months of this information on an authentic credit report. This obviously isn't an authentic credit report, so it doesn't really have that full 24 months. So this one indicates, David, if you want to throw that back up there, that the minimum payment required is $25, and so clearly that's the minimum payment due on the account. There is a last payment date in the trended data fields, and so that would indicate the last payment when it was received by the credit card issuer. So term length, this is normally where you would see, for example, if this was a mortgage, it might read 30 years. If it was a car loan, it might read something like 48 months or 60 months. This would be something that is more commonly reported with installment loans, where it would indicate the length or the full length of the actual loan amount. Past due, and that is in fact a Metro 2 field. Past due amount is definitely a Metro 2 field. Since this account has a payment rating of current, it means that there should be a $0 value in the past due field, which there is. If there was a value greater than 0 here, then this account would be considered a derogatory account, because past due accounts are considered derogatory. And past due, the presence of a past due amount is considered in the payment history category, so the big 35% slice of the pie. Yep. So the next one is account type. This is another way for the creditor to be able to identify the type of account. So no credit scoring system would ever confuse this as anything other than a credit card, because it has those account type codes that clearly delineate that it is a credit card from any other type of account. So payment frequency, sometimes you'll see monthly, normally, and this is kind of a holdover from legacy credit reporting. Most payments are due once a month. And so normally if you do ever see a value there, and then it usually indicates that that the payment is due on a monthly basis. And I think there was one more. So that's credit limit. I'm surprised they put this at the very, very bottom. This seems like it would go higher with the high. It actually should be right next to the high balance field. But this would be the reported credit limit, which is a Metro 2 field. Obviously, it is considered in credit scoring in the utilization metric in the amounts owed category of metrics. And that would be something that is reported or furnished by the credit card issuer on a monthly basis. And obviously, if it changes, then the credit card issuer will report the new limit and it will replace it up or down accordingly.
And now you guys got a full run through of what's been read on the credit report. Actually, that did have the 24-month history down at the bottom, but it expanded too far and it wasn't really nice and neat, so I cut it out.
Understood.
Okay, excellent. That was a lot of great information. Thank you for that. Where are we on time? Okay, we're coming down to the end. Ralph Rodriguez has got a question. I have a charge off on my credit. Now they never gave me a payment plan. Do I have to pay it? It's about 2 years old. All
Well,
right.
I mean, fundamentally, the question is I hate to answer a question with a question, but the question is do you owe it? Is it your account? Do you owe it? If the answer is yes to both of those, then I think you kind of answered the question. Of course, you should pay it. Do I have to pay it? The only time you'd have to make a payment is if you legitimately owe somebody money, right? If you don't legitimately owe somebody money, then you don't have to. You're not obligated to pay them. But if you do owe them, then the answer, is yes. You have to pay them. And if you don't pay them, then obviously you didn't pay them, which is why they charged it off. They wrote it off as a loss, and they reported it as such on your credit report. They're not required to give you a payment. They gave you a payment plan when you open the account, whether it was a credit card or an installment loan. This is a little tough love, Ralph. When you open the account, they gave you a payment plan. You either paid monthly some amount until you paid off the loan, or they gave you minimum payments every month if it was a credit card, and that was your payment plan. And so there's no obligation for a lender to give you yet another payment plan once you've defaulted on a credit card account. If a debt collector has the debt, they also do not have to give you a payment plan. They're not creditors. We talked about open type accounts a minute ago when we were looking at all that stuff on the chart that David made. And open means payment in full upon demand. And so they don't have to give you any sort of a payment plan if they don't. They can certainly choose to do so if they want to do so, but they're not required to do so. If it's 2 years old, then you've got 5 more years of credit reporting. And if it's a large enough dollar amount, it's probably in your best interest to try to come to some sort of an agreement with the creditor, maybe offer a settlement and see if y'all can work something out, and then, move on with your life.
Yeah, always a good thing too. If you've, depending on how long you've been on this live, or if you've seen lives in the past, one of the things that you'll hear John say, and you'll hear me say, is that do your best to honor the agreements that you entered into, and you'll never hear us say don't pay something. Now, I know in the credit repair space, you'll hear a lot of nonsense about, oh, don't pay collections, never pay collections. It drives me crazy when I see that, because at some point that arrangement needs to be settled. There is an agreement in place, even if there was a default on that agreement, and a settlement at some point is going to be your best bet, whether you pay it in full or do something that's less than. But
I remember sitting in an audience. I'm not going to mention the person's name because we all know who he is. He's a very, very, very well-known financial celebrity person. And I sat in an audience, and I remember I worked for FICO at the time. I remember this like it happened yesterday, and I had a coworker sitting next to me. And this presenter got up on stage, and we were at the Federal Reserve Bank of Atlanta. We weren't at, a bar. We were at the Federal Reserve. And so there are a lot of people there in high-level financial positions. And this guy told, I don't know, maybe 300 or 400 people, don't ever pay collections. Don't ever pay your collections. And we were like, I can't believe he just said that. And it wasn't on video. You weren't allowed to video record anything because where you were was a highly secure. You can't start going around the Federal Reserve Bank and video recording things. They don't let you do that. But I was befuddled, flabbergasted that he was saying stuff like that. And we were like, oh my God. We were like, we don't want to be seen here with this guy making these comments. So yeah, if you ever hear the words "don't pay your obligations" come out of my mouth, then it's probably fraud, because I've never used those words in that order in any serious context.
Yeah, I know exactly what you're talking about. Okay, just wrapping up here. We're coming to the end. Ralph, it was a repo on a vehicle you gave up voluntarily. Hey, listen, repo's a repo. Doesn't matter if the repo guy comes and hooks your car up or you give it back. Repo's a repo. Yeah.
So what they did was they sold your car at an auction, and they used the proceeds from the sale of your car to pay off whatever amount you owed, which probably did not pay it off because it never does. They also had to pay the repo man. Actually, no, it was a voluntary repo, so they didn't have to pay a repo man. But you have now what's called a deficiency balance, which means you still owe them money. And if you want to call them and ask them to forgive the debt or settle the remaining amount with you, then that's great. Again, they're not required to do so. That's something that the creditor or the auto lender is going to have to decide on their own how they want to deal with that.
So just to wrap up here, John, maybe you might want to speak on this, and then we'll call it a day here. We're at 52 minutes.
Okay.
But how does this affect? Now, we talked about the difference between industry-specific scores and generic scores. Like, you go in to buy another car, they're going to use, most likely, one of the many auto FICOs. And the reason why there's industry-specific scores is because those auto FICO scores, if they use FICO, which is probably a good chance, how does something like that affect an industry-specific auto FICO score having a repossession?
Well, it has more of a negative impact than it does on the generic FICO score. These auto-specific versions are tuned in such a way that they pay more attention to how well you have managed auto obligations because they're semi-customized scores for auto lenders. And while auto lenders care about how you pay your mortgage and how you pay your credit card, they really care a lot about how you pay your auto obligations. And so the scoring systems are tilted in that favor, meaning that if you have a stellar payment history on auto loans, you're actually going to score higher with auto FICO scores than you would with generic FICO scores, because you're actually a better credit risk for an auto lender than you would be for, say, a mortgage lender or a credit card issuer. So they're going to punish you if you default on an auto loan, because that's what they're designed to do. They're designed to indicate to a lender that you're an elevated risk for another one of those types of accounts because how you performed on one that you had in the past.
Yeah. Okay, thank you very much, John. I appreciate it.
Yes, sir.
For those of you watching, if you posted a comment, I did my best to go through and make sure I posted everything that I saw. But if I missed something, I'm going to scroll through and then answer those personally. But thank you so much for joining us today on this live Q&A. John, thank you for being the special guest today, and we'll do this again next week. All right.
Thank you for having me.
Thank you, everyone. Take care.